Good morning, and thank you for coming for our panel on impact investing. I just saw the title was Impact Investing, Does It Have Impact? I think it could equally have been described as Impact Investing, Is It Investing? We have a truly, or is it venture philanthropy by another name? We have three real experienced practitioners with us this morning. I'm going to give very brief introductions to them, and then they can go a little bit into their relevant background as we go forward this morning. On my immediate left, from JP Morgan Chase social finance area, is Amy Bell, who came all the way from Queens, New York to be with us today. On Amy's left is one of the true pioneers in the field of social finance and impact investing, Mike Dorsey. Mike is now a managing partner of the Wesley Group, but was with JP Morgan Chase initial fund in this area. And on my far left is Michael Smith. He is director of the Social Innovation Fund at the White House and has agreed to answer your questions about Obamacare after our session today. So I'll ask each of our panelists in turn just to describe a little bit more about your background, how you came to invest your own time in impact investing or social finance, and how you would describe sort of the status of the field as of today. Amy?
Hi, thanks, Bill, for the introduction, and it's good to see everyone here this morning. So I am part of the social finance team at JP Morgan, which is a business we launched back in 2007 in response to what we saw as were a lot of trends pushing people to think about ways to better incorporate values into their investments. And some of the things were mentioned in the introductory remarks around the potential for incorporating value and thinking about the long-term social and environmental impacts of your businesses as potentially having also a positive impact on returns. And this business was launched to help support a field of impact investing, which we define, and we can talk more about definitions as we go through the panel, as just being any investing activity where the success of that investment is contingent upon achieving both a financial return as well as some sort of positive social and environmental impact. What those impacts are and what those returns are can vary depending on the investor's opportunity costs and their focus and what they care about, but that's the core of sort of what we're focused on. And we manage a proprietary commitment to that market. So we're investing our own capital through funds that will help demonstrate the efficacy of that model. We're also writing research, which I know a lot of you will have seen if you spent some time looking at this field and doing some work with our clients. And a lot of this sort of a nice arc of development, starting with Mike and what he did at JP Morgan with DBL Investors, which is now separately spun off, but just overall a focus within the firm and thinking about better ways to serve our clients as they're thinking about incorporating the things that they care about beyond just traditional philanthropy and aid. I personally came into this. I grew up basically in JP Morgan's investment bank. I'd done some consulting prior to that, but sort of came from a traditional finance background. But at age of 17, I formally launched my campaign to take over the World Bank and fix it. So there was some personal interest at heart. And so for me, this is sort of a long-held fruition of sort of bringing together an interest in development and thinking about ways that we can help the world and using a skill set that I personally possess, but also something like JP Morgan Chase holds in order to help advance that.
Well, Bill, as you know, for me, it was completely accidental. I was raising money for Stanford for my 25th reunion, and I called on one of my college classmates, Nancy Fund, who was working at JP Morgan Chase at the time, and they had been approached by the Bay Area Council, a woman named Sunny McPeak, who back in 99-2000 observed, as many people did, here we have all this prosperity through the internet bubble, yet we still have pockets of poverty around the Bay Area. What can we do about it? And they had the creative idea to do three funds, one an environmental remediation fund, one a smart growth real estate development fund, and one a private equity/venture capital fund. And they approached JP Morgan Chase largely because they knew that all big financial institutions have a Community Reinvestment Act, CRA, obligation that causes them to do things for low and moderate income communities. So the innovation really was in doing research to validate that done right, which is to say leading with your head and not your heart, you can make market returns, or I would assert above market returns through this practice. Now, you have often said it's just investing. And I think that the way I define it, which is to say no compromise in financial returns and employing, I should say, responding to public sector incentives, government incentives and others, which after all, that's what CRA is, working with charitable institutions, foundations and others, and engaging the community, it is one type of just investing. And done that way, I assert it can make above market returns.
Good morning. I'm taking this probably from the more nonprofit angle with the Social Innovation Fund. I was appointed to lead the Social Innovation Fund just about 4 months ago, so I'm very new and will not be answering any questions about any government websites afterwards. Prior to leading the Social Innovation Fund, I was at the Case Foundation for 7.5 years, most recently leading the Social Innovation team, where we were really just trying to jumpstart our efforts at the Case Foundation around impact investing. I think all of us come to this work from the same place. Those of us that are charged with finding and funding solutions to problems in our communities, we're oftentimes not keeping pace, especially if you look at it on the nonprofit sector side of things, where we don't have the same market forces that drive innovation. So while the scope and the scale of challenges that are facing us as communities all over the country are getting bigger, more complex, are moving more quickly, we're still looking at the same approaches. So we have to have innovation. With the Social Innovation Fund, it's though not only about new solutions, it's also looking at the reality that in the nonprofit sector, we make far too many decisions based on anecdote, based on isolated stories of success, based on numbers served, and actually not impact. So what we're looking at is how can you move more evidence-based approaches to creating change. And so with the fund, we actually fund grant makers who run sub-grant making competitions, and every one of our grantees that comes in has to have at least a preliminary level of evidence that their intervention works. And then we do rigorous evaluation to see if we can prove out the model and then move them on to bigger funding sources, scaling them at the same time because the urgency is so important. We're going to move at the same time. It seems like such a common sense approach, but for those of you that have worked in the nonprofit sector, you probably know that 1 in 8 nonprofits spend $0 on any kind of evaluation. More than 50% don't even have logic models. So trying to move the conversation to say the way we're doing things is no longer working, the problems are so urgent, we have to start looking at this in a different way, which I think dovetails nicely with what's happening on the impact or private sector side of things.
So I ask each of you, how important a phenomena is this as of now? Do you see institutional investors or high net worth individuals actually allocating funds to this as an asset class? If so, how are they thinking about this? Is this going to be a sustainable, lasting phenomena? Or is this, as JD said, the latest form of venture philanthropy?
So I'll comment it from my perspective and what we've seen over the last 6 years. I think initially when we launched this, we were one of a few what I would call institutional investors who'd sort of allocated a portion of capital to put into this market. We said, let's ring fence $100 million and try and invest it. And there were a few other institutional investors like TIAA-CREF and Prudential here in the US. There's a number of Europeans. They're a bit further along, I would say, in terms of committing capital because of the overall attitude towards socially responsible investing there in that continent. And we said, okay, well, let's try this. If we don't start putting money to work and trying to get deals done and demonstrating the efficacy of the model, we won't encourage others to do so. And what we've seen happen over the last 6 or 7 years is we've had a groundswell of interest from the private bank. If I want to hold an event or have a coffee, all I have to do is tell people it's about impact investing, and I will have a standing room only situation, which is great. And what we're trying to work on is how do we convert that interest into real commitment? And I think that's still slower, in part because people are looking at this and saying it's a new market, there's a new set of investments out there. I don't see a lot of track record of people actually being able to achieve return in impact, and people skeptical about whether or not pursuing impact may lead to a compromise in return. And I think there are a lot of people like Mike, like myself and others who feel that there are models where actually achieving very high commercial and competitive returns can drive much higher impact as a result. I would also just say that there's a lot of people, the way people are tending to organize around this is similar to what we have done, which is to do this ring fencing. So almost treating it, for at least for the time being, as though it were an asset class in order to provide the appropriate institutional support and to support that activity, to develop measurement and frameworks for impact, things like that. But my hope is that over the long term, we'll just see this become an approach to investing where you're sort of contemplating those assets that really do generate a high level of impact in addition to returns.
Mike, is this an asset class?
The way I define it, I would say it's not a separate and distinct asset class. I certainly agree with Amy, particularly among high net worth individuals and families. There's a huge increase in interest in this category. And, you know, the other sectors that people often talk about, in addition to energy and the environment or clean tech, would certainly be healthcare and education, where obviously we have huge social problems that need to be addressed. And so I think that you don't have to be only an impact investor per se to see those opportunities and to focus in those areas. But it is true that focusing in those areas, you have to be very involved with government policy, and it is very beneficial to work with others in the charitable sector to help achieve the goals of those companies.
So, Michael, I define social in the context of social impact as the values that we have here in Palo Alto. How do you define social?
So, you know, I think when we think about social innovation, we think about it at the White House Office on Social Innovation as not just new, but better, more effective. We take it a step further and we look at data-driven, and we look at it having an outsized effect on the public good. And so lots of folks on the East Coast get nervous when we start talking about innovation. Are we going to be running after bright, shiny objects and creating things that people don't need? And I think there's a great place for folks that are funding the early stage and sparking new investments and throwing pasta on the wall and seeing what sticks, like we did at the Case Foundation. But when you look at what we're doing at the White House Office on Social Innovation or the Social Innovation Fund, we're trying to be a little bit further down that stage and taking all of the things that you've broken that actually show some signs of working, or the ones that didn't break, and trying to scale it and bring it to the next level.
So we have about 20 minutes left, so I think it's time to kick up some dust.
All right.
Let me give you an alternative view of impact investing. As Mike said, if you look at it, it's not a really very well documented field, but I would guess probably 3/4 of it I would call investing. If it's above market return, you know, you can invest in whatever you want. Probably 1/4 of it is below market return investing, and I'm just not smart enough to figure that out. It's certainly never going to become an asset class, and if high net worth individuals or private foundations want to believe that they can invest in Kenyan agriculture from Redwood City, California, God love them for doing it, I would think of that as really a form of grant. So what's your reaction to that this is really just another phenomena that, like so many things in the social sector, it's not a bad idea, it just is a small, not very scalable idea. One example, if you pick, say, the total size of the endowments of major U.S. foundations and private universities, which might be a proxy for money that's available for impact investing, it's about $500 billion. And if you take the total corpus of sovereign wealth funds and global pension funds, it's about $50 trillion. And that to me is just illustrative that investing for full market return is and is likely to continue to be a couple of orders of magnitude more positive a force for social impact globally than impact investing is. Amy, what do you think of that logic?
Sure. So there's a couple things I would react to. One, I think that what differentiates impact investing from, say, generally investing per se is the focus on impact as a success metric. So it's refocusing, it's putting the same rigor into you put into financial returns and accountability as you do around impact, and that's going to be true for both more for-profit as well as Michael highlighted. This is something that they're very focused on with the Social Innovation Fund out of the White House, so there's some benefits from a nonprofit standpoint. I think on the returns component, I think you're right. There's a lot of sort of investing that ought to be very competitive and has the potential to do so, and I hope that that will just become, the way of the future as far as investing, but I do think orienting towards impact holds value in terms of being able to point to, again, the virtue of actually pursuing an investment where there is both return and impact in consideration. I think the below market return opportunities are ones that are providing a lot of enthusiasm and excitement amongst a philanthropic set of investors who say this is a more financially sustainable way for me to give away money if I can actually put some, again, sort of an investment rigor into the way that I put money to work within certain of the projects that I care about, where it's appropriate to do so. Not everything is appropriate for investing. Some things should always receive grant and aid. Then this is a very interesting way to actually think about sustaining. If your opportunity cost for capital is to basically suffer 100% loss, as you do as a grant maker, then if you have something that returns principal or some nominal rate of return, that's really exciting because you've now doubled the ability to do that. And the other power of that type of capital and what a lot of foundations and other philanthropic investors are coming around to is saying, if I can use that capital and provide a guarantee or some other sort of first loss capital, I actually have the ability to attract some of the bigger pockets of money that are in pension funds and amongst institutional investors because I'm not asking them to sacrifice return. I think on the institutional investor point, now I'm trying to remember if I've caught everything in your discussion, but I think there is going to be some need to think about where regulation and policy plays a part in encouraging institutional investors to consider this as an activity. And that's why you look at foundations and you look at their endowments. A lot of foundations have activity through their grant program on this front, but are not doing a lot on the endowment side. And part of that is, as institutional investors, we still have a fiduciary obligation, and particularly in the U.S., it's quite rigid, and people are terrified of being sued. So we have to think about ways to give people comfort. But again, we're seeing an increasing number of institutional investors who, because TIAA-CREF is a great example, their stakeholder base are teachers, and they obviously care about a lot of social and environmental issues here in the U.S. And so they were able to get approval to make an allocation to this market, and they made $100 million initially, and they've now allocated more capital to keep doing this work because of the success that they've had in that portfolio. So those are sort of the reactions that I have. I think there is, from a scaling standpoint, this will come back to investors like ourselves and others and folks like Mike who are putting money to work and being transparent around the successes and the failures, and hopefully it'll be the successes that help open the door for others to come into the market.
And Mike, you've had a very successful career in this, close to 20 years?
12, actually.
12?
Feels like 20.
Feels like 20? So do you think this is a real underlying structural phenomena or just another passing fancy?
I certainly do think that it's a real phenomenon. However, I would say I don't think it's a new phenomenon. With the 50th anniversary of President Kennedy's assassination, I'm sure many of us have been reading about that period, and perhaps the greatest social need during that period was perceived to be having a very strong defense capability to be sure we defeated communism. If you think about that era, Hewlett-Packard, Watkins Johnson, a lot of other companies that are right around here received a huge amount of funding from the federal government to pursue that social mission. Fortunately, it was very effective. Today, I think, while that still exists, we have other areas in which public policy and funding supports a great deal of private sector effort and opportunity. So I don't see this as that new, again, the way I define it, which is, I recognize, just a small sliver of the overall impact investing opportunity.
And so I'd ask you and Amy, tell us your favorite high impact, high return investment that you've been associated with, the one that you just go, wow, I can do well by doing good.
Sure. So we have a portfolio of a number of things, and it's still fairly early days to see where they'll come out in the end, but we're invested into a fund called Leapfrog that's focused on insurance, savings, and pension for people largely at the base of the pyramid in Africa and Asia. And insurance, because of the proliferation of financial services, particularly loans and credit and savings, is something that people are now jumping into. And Mike mentioned healthcare is a sector that people are very focused on. And if you're starting to think about providing healthcare for people, it's very natural to sort of jump to this concept of insurance. So this is a sector within certain markets in Africa and Asia where there is great potential because you have effectively an emerging consumer base that needs products and services. Demanding them is finding informal and sometimes not so great formal ways to actually use that, and they're providing a much more appropriate, accessible, and affordable product to do so.
And that's an impact investment in the sense that it's below market return or not?
It is, no, its position is being fully commercial and competitive with traditional private equity benchmarks. And they would argue that they sort of talk about profit with purpose, and that they're trying to maximize impact and returns in their model. The impact being that providing these people a means to manage their cash flows and protect them against shocks, which is actually the shock of an event like a death is often what plunges people back into poverty. Actually really helps them manage, and so they start to springboard out of poverty from that standpoint.
So, Mike, I know you have several very famous social investments that have had very attractive returns. Which one would you describe for us?
Well, if you don't mind, I'll just mention two quickly. And those are first, of course, Solar City, which now employs over 3,000 people and provides electricity in, I think it's 15 states for a cost lower than provided by the grid. And, I think that while they've been very successful already, they have a very, very long way to go because of the fundamental economic opportunity that exists. And when we first invested in that, there was a huge amount of skepticism because, of course, the cost of solar was much higher then, but also there was a skepticism that one could make any money in a service company. But with the cost of financing having come down quite a bit, the introduction of a solar lease, and most recently the securitization, where now the project finance costs Solar City 4.8%. I believe it's a terrific opportunity. And they also worked with Skyline College and others to train entry-level people. So it was a great success as a social investment as well as a financial investment. Secondly, Revolution Foods, which provides natural and organic school lunches and now breakfast and suppers, also in 12 states, and has recently introduced a line of consumer products. Also, it was an obvious problem, right? I mean, most of the school lunches that were provided at the federal free and reduced lunch price of about $3 were barely edible and not nutritious. So there was a great opportunity, but they were the first ones to come up with an economic model that could successfully pursue that. So those are two.
Bill, if putting on my old Case Foundation hat, it's only 4 months old, for a second. I assume most folks know Zipcar. Zipcar was an investment that my bosses made. How many of you would say that would be an impact investment, Zipcar? Okay, so a little more than half of the folks in the room. Zipcar, one car takes 7 cars off the road. Originally, the investment was made to FlexCar, which was started by municipal employees that really had an environmental bent. But even within the Case family, literally Gene and Steve Case, they disagreed on whether or not Zipcar was an impact investment. Gene Case would say it absolutely is because of the work that it does to help the environment. Steve would say no because it wasn't social forward. And so you have to ask yourself, how much of this is the Wild West right now? And do we just need lots of different experiments that are taking place as opposed to how much more definition do we need? I feel like the academic circles, and it's good to be here at Stanford, you could kind of get caught in this paralysis of analysis, waiting for the perfect definitions, waiting for the perfect metrics. And I think the way that we looked at the Case Foundation is we just need all of our oars in the water. So we had traditional grant making that we did. We could throw things over to the wall to the private investment side and do things like investing in a Middle Eastern venture capital fund or investing in a for-profit crowd mobilization solution. Just realizing that need is at an all-time high, resources to social sector organizations especially are flat. We've just got to do more and try new things.
And as you sit at the White House's Office of Social Innovation, how do you view the various elements of this? The investment side of it, do you think that's going to be the most powerful source for social innovation, or the social impact conscience part of it? Where do you see the most innovation coming from?
Yeah, I think our goal, and I specifically am focused on the Social Innovation Fund, but I think our goal, and if you look at what Jonathan's doing, leading the White House Office on Social Innovation, is how do you create lots of on-ramps? So there are folks that are in the private investing side that just don't see themselves in philanthropy. Many of my former boss's peers who just could not get comfortable at a philanthropy conference. They don't speak the same language. They never knew what the returns look like, and so they kind of stay away and end up doing a lot of charity. So how do we create the proper on-ramps for them and tools like impact investing where they can get involved and make major impact? How do we fix, I think, what is a broken philanthropy system that has billions of dollars that are going to organizations that have no sign that they're actually making a difference? And we have appropriators that have a pet project that keep them funding. We believe in these isolated stories of success, and we don't do anything. There's interesting work that's happening on Pay for Success, whether that's paying for results or whether that's social impact bonds. And so I think it goes back to this: all oars in the water. How do we create clear on-ramps? And then what can we do in Washington, to remove barriers and to get out of the way? I think there are some times where we can push, we can experiment, we can co-invest, but a lot of what we need to do is clarify the rules and also help to move some things out of the way.
So, Amy, what's it like? Oh, sorry.
Yeah, I just wanted to build on that briefly because I think this is an important point. We have another fund that we're invested in that I'll put into the quarter of things that are sort of a below market return called the Global Health Investment Fund that focuses on funding later stage research and development for treatments that will address malaria and tuberculosis and other diseases that have a disproportionate impact on the developing world. We did this in collaboration with the Gates Foundation and spoke to a number of large institutions, individuals, and other sort of mission-oriented investors around it. And one of the big learnings from that experience was talking to people and helping them figure out how do they consider an opportunity like this, and how do you get people to start thinking with both an investment as well as a philanthropic mindset. And I'm happy to say we were successful in raising $100 million to support this fund, and we hope it'll be one of many in the future. But I think this is an important part of the discussion. I think it's hard to talk about this stuff at sort of an academic or high level without actually talking about actual deals and how you get this type of thing done. And that's where you bring in people and start having these conversations to do that.
So we sit here at Stanford Business School where MBAs normally don't go to work for JP Morgan Chase, the largest bank in the U.S., and yet you seem to have crafted, almost the perfect situation. What's it like doing this in a very large, complex institution?
It's a great question. I find that I have to explain myself a lot. We have 260,000 employees. I would venture a lot of them have no idea we even exist. So I'm constantly having people who are discovering this because a client has encountered our research or they've heard wind about this impact investing stuff and they want to know. And there's like, so we do this and why are we doing this? And you're a business and how does this all, you're not part of the foundation. So we get all these types of questions. So there is a fair amount of time, and I would not have anticipated given I sort of like doing deals and making investments. I have probably about a quarter to a third of my time is spent educating people and talking about this market. And I think one of the values that our team has is everyone on our team comes from the commercial side of the business and is helping to manage this. And so when we have conversations, there's at least some credibility around this. But I think still the same type of questions and skepticisms that are present in today's market in terms of can it scale, what types of returns can it generate, those things like that. But it's a really interesting place to be because obviously we have a whole lot of other things that are going on, and this is a small activity within the context of a $2 trillion balance sheet. But it's becoming an increasingly important one. I mean, the guy who runs Sub-Saharan Africa for JP Morgan Chase, we've probably put to work about $15 or $20 million on the African continent, and he thinks this is one of the best things that he can showcase in front of clients because it's not the dollars that matter, it's the fact that we're making this commitment and that we're really focused on it. And Mike may be able to comment as well, given he sort of worked alongside of this sort of in the early days.
Well, I certainly agree with you, Amy, and I think all organizations need innovators. And, that's human capital is what creates innovation. There is no shortage of capital in the world. There's no shortage of big infrastructure, generally speaking. Of course, there are pockets of that. So it's I think what as you point out, Bill, Stanford breeds and promotes is innovation and entrepreneurship. And all of us need that, whether we're in the government sector, the social sector, or the for-profit sector, or, of course, the sectors that overlap all three.
So if you were a Stanford MBA or a recent graduate and you were going to commit your career to social impact investing, what would be the right first step or the right set of skills to have?
Well, you should know how to invest. Unfortunately, the impact investing market is so small. There aren't a lot of large groups that are doing this that have robust training systems. So the path a lot of people take is to go out and get sort of a traditional investing experience, build on that, and then bring it over. I mean, I spent 7 years in our investment bank before I moved over to social finance at JP Morgan, and that upbringing, I think, has really benefited me in terms of what I'm able to bring to the table as far as a value add. So I do recommend that. I also recommend thinking creatively about the opportunities. I mentioned when I was younger, I was very fixated on World Bank and thinking about development and sort of the traditional paths. But there are a large number of sort of corporates who are really rethinking what corporate responsibility means and are starting to make some really impressive, slow-moving but impressive changes internally to sort of affect those goals. And I think you have a choice if you are someone who wants to innovate and create change. You can fight the system outside of it, or you can get inside and start creating ruckus. And I choose the latter, but I think there's lots of ways to think about doing it. And I think there's some real opportunities, given where things are moving, to do this inside of a large corp.
Mike, large or small?
Well, if you'll indulge me with another reference to President Kennedy, he had a hero's view of history. He thought people made a big difference. So I would say that for people graduating from Stanford Business School today, they should seek to work closely with someone for whom they have huge respect, learn from that person, and it doesn't matter much which of the sectors that it's in. I do agree, though, if one seeks to be an impact investor, having a traditional grounding is perhaps the most important thing to do.
So we have 2.5 minutes left, and so why don't we try to get a couple of questions in, perhaps? Are we set up for that? No, not really?
No.
Yeah, just yell.
I'm Kim Meredith from the Stanford Center on Philanthropy and Civil Society and SSIR, and last week we posted
So Kim raises a good question. There are, seemingly an infinite number of parts of Stanford that are creating startups with attractive financial possibilities as well as social impact. And you are beginning to hear what Kim says, which is we'd actually like regular money. We don't so much want money from the social venture firms because it communicates more widely that maybe we're not really a serious business. Are you seeing any of that or not?
I think, we talked about the skepticism investors have and whether or not if investing for impact implies or perhaps connotes any sacrifice on the return perspective. And certainly there's a lot of us working hard to disprove that. But because of that skepticism, you also see it on the company side, which is that if I'm holding myself out as a social enterprise or an impact business, if I'm going for that type of capital, does that imply some sort of softness? And I think this is another dilemma within the market that's only, in my view, sort of really answered by showcasing the types of deals that are getting done and showing that, a company like Solar City or Revolution Foods, the funds that I mentioned, Leapfrog, and even the Global Health Fund, which has a very different return profile, there's nothing whatsoever soft about any of those. If you want to ask any of my investees about how we engage and what we're focused on, they would sort of concur with that. So I think this goes back to, in general, when you talk about investing, there's always a desire to sort of find partners on both the investor side and the investee where the values and the ambitions are aligned. You know, I had that experience when I was in mergers and acquisitions, and as part of our investment bank was working with a number of companies who were looking at selling themselves. And one of those softer and tangible questions is, how do we find the right buyer that actually believes in what we're doing and is going to support the business in the best way? And I think impact just looks at, you know, a different type of metrics and skill sets to actually do that, but it's still something that can be just as rigorous and hard as traditional investing. And it's just something that through experience and through showcasing deals that I hope will remedy.
Well, the sole role of a good moderator is to finish on time. And so with that, Amy, Mike, and Michael, thank you very much. It was a terrific discussion, and thanks to all of you.